following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today on 94.1 FM WNBU or Cable TV 10 in New Bern, North Carolina. We also have our shows streaming on the web, not live streaming, but you can download a copy to your MP3 player, iPod, or you can stream it right on the web at your convenience whenever you want at www.dlblain.com. As always, our ideas for the show come a lot of times from our viewers and listeners just like you, so we encourage you to contact us with questions you may have about a topic we covered, something we haven't covered, something you like to hear about. Our email is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And our phone number is 252-633-0107. Okay, today we're going to talk a little bit about some things that are going on in the marketplace, as well as we're going to talk about some long-term principles of investing. As we always do, try to focus people on the long term, stay out of the short term noise of the market. The first thing is there's been a lot of talk ever since the financial crisis of 2008, which is beginning to fade from people's memory. There's been a lot of what we would call de-risking, or people think they're de-risking. That's the point of what I want to talk about, is people that experience severe declines in their portfolios of stocks during 2008 and the first part of 2009 have spent the past few years dumping stocks en masse for the presumed safety of bonds. And I want to talk about that for a minute. Since the end of 2008, investors have taken out $105 billion out of U.S. stock, mutual funds, and exchange-traded funds, and they put in, according to an analyst at Morningstar. So net, some people have been putting in, some people have been taking out, but net, they've taken $105 billion out. Last year alone, they took out $34 billion holding the biggest growth stocks in the U.S. And what they've been replacing it with is a couple of things. Number one has been bonds, bond mutual funds, bond ETFs. There's been a lot of interest in sector and industry ETFs. Sector and industry mutual funds. So as they've been pulling money out of the stocks, they've been going a lot into bonds as well as very specific sectors of the market. We've also seen a lot of outflows, especially last year, from European securities. People concerned about the euro, the collapse of Europe, the collapse of Greece, et cetera, and so they've been pulling money out of Europe. Well, the point of this segment and what I want to talk about is, are these investors really lowering the risk of their portfolio? Or are they unintentionally raising it? Typically, when people chase past performance, which is bonds have been doing very well the past several years, typically when people chase past performance, they end up losing or not doing as well as they should. And we happen to think that that is going to be the case going forward, that this rush to the bond market is a very big mistake, that in fact, if people have the risk tolerance or risk capacity to do so, that they should be raising their equity allocations. Now, the market has had a big run. The Dow's hovering around 13,000. It's probably fair value on the market. So not the tremendous bargain that we saw in March of 2009, or even the end of last summer, and after the third quarter, stocks were a relatively decent bargain. We've seen quite a run-up since then. But if you look at the alternative, the bond market, stocks look like a screaming buy compared to the bond market. I mean, it's amazing if you look at some of the maturities on U.S. Treasuries and the yield, that you actually have a negative yield, that you're actually paying the U.S. Treasury to hold your money. Now, We don't think you should shun bonds completely. They still provide good volatility protection. I have a little program that I use, that I wrote, that analyzes every day that the market goes down, what went up. And I use this to see what we want to add to our portfolios that are going to provide downside protection. And last year, and certainly this year, when the markets are down by more than 1%, there's one asset class, and only one asset class, that has consistently gone up, and that's U.S. Treasury bonds. Well, and I should say U.S. TIPS as well, Treasury inflation protected securities. So whenever the equity markets run into trouble and decline by 1% or more the past year or two, the only thing that has provided protection is U.S. Treasury bonds, not foreign bonds, not corporate bonds, not high yield bonds. Now, to some extent, it's not every time, but for the majority of the time. Now, is this a bubble? Is it going to burst? Well, we don't know. We think the bond market in general is overvalued, but they still provide some downside protection. So you have to balance that, the fact that most bonds are overvalued and are not going to provide much of a return going forward, versus they are still the only thing that's providing a buffer to the stock market decline. So we look at when people are de-risking their portfolio, they've moved away from stocks, they go into bonds, and then they look at the Treasury, they say, gosh, I'm only making 1% or 2%. Oh, what about these corporate bonds, or what about these high yield bonds? They're still bonds, but gosh, they're paying 5 or 6%. Well, investors have unintentionally, or maybe without knowing, they have added that equity risk back into the portfolio, that high yield bonds are very highly correlated with the stock market. Yes, they're called bonds, but they typically rise and fall more like stocks than bonds. The same thing with emerging markets. There you have a lot of fluctuation based on the value of the dollar. Yes, the emerging markets seem to have very solid economic finances, but once again, you've introduced some element of risk. You've introduced currency risk if you're buying foreign bonds that are denominated in other currencies. So you've interjected other risks into the equation. And of course, the biggest risk with bonds is that as interest rates go up, the value of the bonds will go down. So anything of very long maturity that investors are buying, they have probably introduced more risk than sticking with the plain vanilla bonds or sticking with the equity allocations in the portfolio. So we want everyone out there to look at your portfolio and be honest with yourself. If you're running from equities, make sure that you're not unintentionally just replacing equity risk with another risk in the bond market or another type of stock market risk. Well, that brings us to our first break. When we come back, we'll continue our discussion about some long-term investing principles. For All Things Money, I'm David Blain.